The TSX finished last week down just a little over 3%. The previous week, it had fallen 2%. And our next guest, he sees some additional downside risks to the market after a 5% decline in 2 weeks. Joining us is David Burrows, President, Barometer Capital Management. Good morning, David.
Good morning, Francis.
Before we go to our outlook for the market, we're hearing more news on this Maple Group bid for the TMX, some new partners into the mix. As somebody who uses the TMX group for a trading platform, what are you thinking about this battle?
Listen, at the end of the day, I think that these exchanges are going through consolidation really around the world. It's a scale business. It is not a necessarily localized market. And so there are some implications here. When you look at a combination with London, there may be greater opportunities for growth and competitiveness. There are some who would say that the Canadian solution may be a little bit self-serving for some of the institutions that are bring the bid.
Well, I'm interested in your thoughts still on this takeover as somebody who runs a company that trades on this exchange. Would you like to see the LSE take over the TMX? Would it give you perhaps better access to markets that you want more access to?
I think that we are continuing to globalize, and you want competitiveness and you want reach. I think to keep a market more localized is not probably in the best interest of the investors.
Okay, let's turn to the news of the day, which is a pretty nasty decline, 2 weeks in a row for the TSX. Not as long as the decline in New York, but certainly almost the same magnitude, down a little bit more than 5%. You think we've got more downside risk in the markets. Why?
Well, Francis, obviously these are very tough markets for investors, and you know, the TSX actually started underperforming U.S. markets, you know, weeks ago because of the high component of cyclical stocks. We think that there could be a bounce in here at any time, and I wouldn't argue that. We are, you know, short-term oversold, but the internal indicators that we look at are not terribly oversold and continue to show some risks. So, you know, we may be a little bit unique. We take care of private investors. I think private investors pay you to find them good ideas, but also to manage exposure based on market conditions. And I think when you look at the way that the commodities are behaving, and especially relative to the commodity stocks are underperforming the commodities themselves, and the various indices to us look somewhat broken down. When you look at the way that financials have been behaving, and first let's look outside of Canada, globally financials have been really underperforming and really technically look quite soft. Canadian banks have started to behave more poorly. Semiconductors, which tend to be a leading sector, both to the upside and to the downside, are very close to breaking some very important support. So if you put semiconductors, financials, energy, and basic materials together, all of them look vulnerable. And, you know, for Canadian investors, this is a problem because 60% of the Canadian market's energy and basic materials, and then, of course, you follow it up with financials.
Okay, so part of your job is finding good ideas for the clients. Let's talk about some of your newer ideas. I think you like Keyera. Tell us about that.
When we look at what the leadership themes are in this market, very clearly what the market is looking for, what investors are looking for, is yield. There are people pulling back from equities, and as a result, they're looking for yield plus some inflation protection along the way. And so our biggest weighting across our portfolios over the last few weeks and months have been real estate investment trusts and then utility-like assets with big dividend yields. So you look at a Keyera. Keyera is a gas processing business where they gather gas, they process it, they strip liquids out, and then they sell those liquids into the oil sands where the producers use it as a diluent to help push the bitumen through the pipelines. So listen, we like to see things that have a high likelihood of success, and I think it's no question that the oil sands are going to have increased production. They're going to double their production over the next few years. They're going to need a lot of condensate to do that. Keyera makes a fee processing the gas and then makes some profit selling the condensate. So 5% yield plus some improvement.
Another one in the yield camp that you like, I understand, reporting also this week is H&R REIT. It hasn't actually protected you too much over the last little bit. It's down about 8%, market down a little bit more from the highs. What are you expecting for the numbers? And talk a little bit about why it's been under pressure.
Well, listen, you know, the REITs have all pulled back a little bit, and that's, you know, the market is very soft, obviously. We find, though, that in this kind of environment, a yield ultimately does put a floor under a position. The Canadian REITs, in general, have very high occupancy rates and very good pricing power relative, of course, to the U.S. REITs. The balance sheets are much stronger in Canada, and the opportunity for pricing power, we think, is there. So they have this new building, the biggest building in Western Canada, the Bow, coming online in 1 year. That will be a significant pickup to their cash flows. So again, we can get a steady cash flow. We'll see an improvement in the cash flows. And for an income investor, of course, the most important thing is getting a yield, yes, but having some inflation protection in the event that your purchasing power gets eroded.
Okay, David, thank you very much for that. And I hope you have a good trading week.
Thanks, Francis. Thanks for having me.
David Burrows, President, Barometer Capital Management.
Well, after the break, we're going to highlight some of the stocks you might want to